Hey Peter, welcome to Startup Project. Thanks for coming on the show.
Thanks for having me.
So we, keep meeting each other in the early stage investing ecosystem here in Seattle, and I thought it'd be interesting to have a conversation about Seattle investing startups. And I think it's as good of a time as any, and especially considering you have a good announcement to make. So welcome to the show. And before getting into your fund and what you're doing in the Seattle ecosystem, can you give the audience a little bit about your background, your career till now?
Yeah, absolutely. Started my career in kind of pure play financial services with Bank of America Merrill Lynch Securities. Then, I think it was weird being in equity research and seeing sales and trading desks disappear, and then, doing initiating coverage reports on tech companies that had only been around for 5 years, and next thing you know, they're going public and generating 100 million of revenue. And there was this thought in my mind of, and I had friends in San Francisco, and they all seem to be having a lot more fun. And I wanted to get into that building side rather than, and a little less on the kind of analysis side. I then shot out to, bought a one-way ticket to San Francisco, ended up interviewing at a bunch of places and really resonated with a small company where I think I thought that I could have the most impact, and that was eShares. That eShares then became Carta. I was a product manager on the 409A and kind of valuation side and helped build out that business segment. Then had some turned out into private equity for several years. And that was also a weird experience. It was this, I was the first hire in a roll-up fund. We concentrated on several different verticals, but I was always the guy saying, "Well, why don't we procure software or build software around this? Why don't we?" I kept taking this framework of success that had worked at Carta and tried applying it to lower middle market and middle market PE. And I think at that time there was still sensitivity around operating expenses when it comes to software. I think private equity's changed a lot in terms of procuring and leveraging software, but I kept banging my head against the wall. And again, I wasn't with the builders, I wasn't with the innovators, and kind of wanted to get it out of that. And then made my way to Seattle. I never thought I would end up here. I really wanted to. I was incredibly bullish on the region, mainly due to the fact that I started noticing the talent density was reaching similar levels that the Bay was in kind of early to mid 2000s. The biggest indicator of that was, Seattle was a dev shop for a while. There was a lot of people that set up satellite offices here to poach a lot of the talent out of Amazon and Microsoft, but it was very, very dev heavy. And then I would say around 15 or 16, if not a little bit earlier, then you started to see product, then you started to see sales from satellite offices, and it really became Cloud City and really solidified that, but it was still dev heavy. And then in, say, 15, 16, I started to see this specialized division of labor start to occur where you started to have people that specialized in, say, you know, growth hacking for a Series A company in e-commerce, right? We need more of that. The Bay has that, and that's like a kind of a competitive advantage of the Bay is just that density and division of labor. But I started to see it, made my way up here, started with Seachange, became partner in 21, and then ran that with my business partner Will and shut that down in June. Deployed all the capital. We continue to manage the portfolio companies and launched Breakwater that same month. And yeah, it's been a wild ride in this market, but a rewarding one nonetheless.
You know what happened in 2015, 16 that changed the game for Seattle?
Yeah, I think it's I don't know. I maybe you could tie it to, the California flight, but that wasn't a big thing. That was much more of a COVID and post-COVID thing. I don't know. I think there's it's hard to put a finger on what exactly is kind of causing that, but I would fair to imagine that there was enough startup critical mass, enough companies in Seattle that had those opportunities to where someone can split off from a big company and move into more of a specialized position in a startup. Um, that's still an issue in Seattle. So one thing that I very much believe is that we're missing this middle layer in Seattle, and that's holding back a lot of the ecosystem. So what is the middle layer? Well, a middle layer are a good amount of A, B, and C and D companies. We have some, but we don't have a ton. And what hinders this ecosystem is one, the capital, the lack of capital being deployed at pre-seed and seed is not helping, and we can riff on that later. But I think more importantly, if we're truly going to leverage this highly skilled pool of labor that we have in this region, then we need to provide, and provide is a weird way of putting it, but we need that middle layer of tech companies so that when someone is like, yeah, I'm going to try my hand instead of marketing for a large organization, I really want to do startups, and you're a late 20, early 30s something, and you jump into it, it's great, it's working well, and let's say that shuts down. Well, now your opportunities are like a handful of startups in Seattle or a remote job with another startup somewhere else, or you have to go back to Microsoft. And what ends up happening is that there isn't that compounding of knowledge and experience in working at startups because of the lack of opportunities to hop to another company. So we're not properly giving enough opportunity to employees that want to be in startups, and it's really due to capital funding. If you look at capital injection at pre-seed and seed compared to other ecosystems, we're we're swinging well below our weight in terms of what we could be doing.
I mean, I think Seattle on paper has everything to be number two in all categories, right? If not number one,
Hmm.
because you have Amazon, Microsoft, potentially, like, depending on the dates, in top three most valuable companies, you have all kinds of talent here. The required talent of a great university ecosystem as well. So on paper, it looks like we should have the second most, at least, top pre-seed ecosystem, but that's not the case. Um, and I think we ranked fifth in pre-seed funding, if I'm not wrong, recently for the last year. Um, Before getting that, can you talk a little bit more about Seachange and how that was operated? And I know like Seachange was slightly different than a regular pre-seed fund. Can you talk a little bit more about that?
Yeah, so Seachange was an annual fund, committed capital, and it was an attempt to inject the ecosystem with, typically risk averse angel capital, and there were full-time managers that were tasked with everything from origination to execution to support. And LPs were provided decision-making power at several points of kind of the deal execution workflow. So top of funnel, middle of funnel, and then the final investment decision. There were certain samples of the LP base that were at top of funnel and mid funnel, and then at final investment, the entire LP base would vote on um, whether or not to do the investment. It it worked great in terms of allocating capital, but I think what we ended up doing is we looked at the loss ratios at the end of the fund, and they were fantastic. Fantastic in the sense that we looked like a middle market, lower middle market private equity shop rather than a true VC fund. And I think that's an empirical way of showing the risk averse nature that we had as a fund in making decisions, right? I think a lot of people in this ecosystem at the pre-seed and seed stage like to see all the boxes checked off. And what you end up self-selecting for there are founders that have everything figured out rather than constantly experimenting and really creating velocity. At the end of the day, we weren't investing in velocity. And don't get me wrong, we had great returns, but it wasn't what a venture fund should be doing in a very risk capital, risk on asset class, especially at pre-seed and seed.
So Seachange was technically not a syndicate, but having run syndicates, because syndicates don't have committed capital. I mean, in your case, you had committed capital. Um, it's actually very tricky to do investing in such, where a lot of people are involved in decision making is what I came to conclusion. Because one thing is when you have a strong um, conviction on something, you cannot translate that across a group, number one, because if it is a conviction that no, people don't agree, that's a bet worth taking in venture because venture technically is risk capital, right? But
Right.
when you are trying to convince a syndicate of folks to invest in your conviction, it doesn't always translate. That means you cannot really confirmly tell the founder that you're investing, even though you really, you know that this founder is exceptional, you like the thesis and everything, and you see the vision. But as a person who's not making the decision, and since the capital is not committed, it becomes really tricky and challenging. So for anyone who tries to do a syndicate, my advice is always like go through the hard work and just do a fund, right? It's
Mhm.
much more easier when you have that committed capital and when you can make that decision because you're not only risking the decision, but you're also risking your reputation with the founders because you want to invest, you tell them that you can invest, but then what if the group doesn't agree with it,
Right.
right? So you're also like risking your reputation. So
No,
I've
and go ahead, go ahead.
So I sort of concluded that, if anyone is trying to do a syndicate form of investing, yeah, you can be a participant and if you like it, invest it, but starting a syndicate is actually a very tricky business and it doesn't scale well. And in your case, you had obviously committed pool of at least LPs. That was slightly easier, but a regular syndicate model actually, you is much more harder than I think by structure itself, you can never get good exits.
Yeah, absolutely. And the what is angel investing in other markets and what is angel investing in Seattle? Angel investing in other markets is typically, hey, hop on a 45-minute to an hour call with the founder, either have a decision by the end of that, or maybe line up one or two additional calls. Um, that's the typical MO for what an angel investment is outside of Seattle. In Seattle, and I would include other geos in this, but I think it's very true for Seattle is an angel investment is now a th 2 month due diligence process with pro formas associated with it. It's kind of ridiculous. I think there needs to be some re-education around what is a true angel investment, and I would say a recalibration of what risk tolerance means and how important it is at pre-seed and seed. The most important thing is, and you touched on this, was you're building a relationship at pre-seed, and you have to see things in the founder. In this business, we bet on the jockey, not the horse, right? And it is hard to share what you're seeing in a founder when you have to just translate it to either a CV or a resume or a pro forma or a deck because it's a very personal endeavor early on to invest in a founder. It's not a it's not a heavily analytical thing. And don't get me wrong, we still do a lot of analysis in our due diligence processes, but it's at the end of the day, you're building a relationship, and that the weight of that relationship and what you see in a founder cannot be easily transferred in a quantitative or in any sort of deliverable unless you throw your thoughts into a long memo. But even then, reception is probably not going to be as good as you would like it.
Yeah, I don't think even a memo really translates into convincing the group. Like you're seeing things. And you brought up a good point. I think some of this angel investing in Seattle is done in almost like a small to mid private equity sense, where you're evaluating cash flow, where you're evaluating business model. While if you're purely looking at pre-seed venture investing in tech companies, that's not really the mental model you should be looking at. Because at pre-seed, you have to expect that there is no business model yet, right? You will eventually create some leverage using technology and create a business model worth $1 billion. Like that's the ultimate goal. But I think we sort of come and traditionally a lot of incubators or syndicates or groups that are investing or doing angel investing sort of create this notion of, you have to eliminate all the risk. But pre-seed is like the most risky bet that you're taking. So your like
Right.
perception of what type of risk you're actually getting involved is also changed.
Well, if you like look at the levers of wealth creation in this region, right? Microsoft was the second largest wealth creation event behind the Holy Roman Empire. And that's great. And it's a good thing. Don't get me wrong. But you have to think about, okay, what were the mental frameworks that helped a lot of people generate their wealth and got them to where they are? If you're in a corporate environment, you're making a decision with 80 to 90% of the data sitting in front of you. And that works for a corporate environment. But if you're to use that same mental framework in assessing a pre-seed and seed opportunity, it's hard. It's very difficult to do. And I think the there are some people that can do it, but there are many that still kind of bring those, well, hey, I need to see 80 to 90% of the data. And then what ends up happening is that I think you do get a lot of founders that are like, okay, I'll put together a 5-year pro forma for you if that makes you feel better. And it sends a lot of angel investors, given, I would say, the education that they've been given as to what angel investing looks like, they have paralysis by overanalysis. They'll spend more time in a made up pro forma assessing the business's ability to generate revenue and therefore returns than talking with the founder and understanding how they're thinking about the market, how they're thinking about product design, how they're thinking about the end user and making them happy, which is much more important than any made up pro forma that is, let's be honest, 99% chance not even going to be close to what the business actually does in terms of revenue and expenses.
You saw a problem, you're fixing it. We don't have a great pre-seed ecosystem in Seattle. So with Breakwater, what is the thesis behind it, and what type of companies are you investing in?
Yeah. So the thesis, we're compounding our learnings from Seachange as well as our networks. What we were observing at Seachange were a bunch of great deals that we had the opportunity to allocate into, but at the end of the day, we were restricted by the decisions of our LPs on certain investments, and that came down to kind of risk aversion. So there's a ton of opportunity here. There are incredible founders here and across the region, and they need capital, and it's not coming from an individual angel ecosystem that's supporting them and propping them up. So for us, we saw it as an opportunity. We've been in market for 8 years. Our networks help us. We have a great visibility and access, but we need to attack it with better decision making and institutional rigor and institutional capital. So we're investing in mainly fintech, AI, ML, marketplaces, vertical, and those are the main pillars. At the end of the day, if you're a software centric founder, I will absolutely talk to you in Seattle. I don't want too many dumb rules to prevent me from seeing a great deal and backing a great founder. The other aspect is also Vancouver. There's, if you look at the fastest growing offices for the large tech companies, they're in Vancouver and they're in Toronto. Why is this? So H-1B issuances have gone down significantly over the past 8 years. And what that's done is it's sent a ton of, oh my gosh, pardon me. Okay, we'll refrain here. Sorry. This whole past 3 minutes is going to be an editing nightmare for you. Uh, we're really interested in Vancouver because if you look at H-1B issuances over the past 8 years, they've gone down dramatically. So what does that mean? There's been a ton of international labor that is now housed in Vancouver and Toronto and Western Canada, uh, that is world class, but can't come to the United States and start their company. And a lot of them are very entrepreneurial. If you look at the fastest growing hubs for major tech companies in North America, all of the hubs that are experiencing the greatest growth are in Canada due to this large immigration surge. So at Seachange, we started seeing interesting deal flow come out of Vancouver in 18, 19, and we pulled aside counsel, asked for an opinion, and we wanted to understand if Class A common if we could create some synthetic preferred share with Class A common in Canada through, writing inside letters. Our counsel came back, said, yes, this is great. So everything will uphold. And we started doing Canadian deals. And to our surprise, they were even more capital scarce in Vancouver than they were in Seattle at pre-seed and seed. So that was an opportunity for us on both valuation relative to traction, and that could be revenue, that could be whatever, but great entry points on valuation. Plus, there's a bit of arbitrage there in the sense that if you push on them to say, hey, become a Del C Corp with a Canadian sub, well, now you're denominated in preferred shares, and that becomes a lot more attractive to the American market. And therefore, your marketability goes up tenfold. You have much more access to capital, and valuations then come to be in line. I think the other thing about Vancouver and Western Canada is that because of capital scarcity, a lot of these founders are incredibly frugal and very understanding of where every dollar in their business is going. And that's a breath of fresh air because I think I get a lot of pitches and founders in Seattle and abroad that it feels like they're still living in a SERP era. And I get it, but it's difficult to talk to someone that's raising a pre-seed round and is trying to raise $4 million. And it's like, okay, hold on. No, not interested in that unless it's a fantastic team that has, outstanding resumes and proven track record of success.
Unless
But
they
if
were
you're for
ex-OpenAI.
well, yeah, and that's another thing. I think a lot of people think if they slap on AI onto their pitch deck that guarantees a 2x increase in funds raised as well as valuation, and then it just doesn't work that way. But anyways, I see a lot of great things coming out of Vancouver and a lot of opportunity for us, uh, not only as a fund but also for Seattle and the Pacific Northwest as a region. A lot of them do want to come to the U.S. and build a company, but we're due to I would say an imperfect immigration system. We're not providing channels for those people to come and work here.
To add a data point to what you said, regarding H-1Bs issued are going down, there's another reason why there's a huge Vancouver migration from Pacific Northwest or in general US, is because of the green card backlog issue. There are at least 1 million people waiting in green card who are highly, highly paid, tax paying, legal, have been here legal for a while, and a new H-1B today, if they come from India and try to get a green card, it will take them more than 100 years to get the green card based on the current timeline. So it's when someone is graduated from the US, even if they study in a very good university, their obvious next choice is to move to Vancouver or someplace in Canada, because they do think that from there they can still access US markets, right? So they can start a company in Delaware, and like you said, it can be a subsidiary in Vancouver or in Canada and still operate and create companies just like they create in the US. So that's one big attraction why people move to Canada. Um,
Absolutely. And I think what's interesting about Canada is that demographically they need immigration in order to have population growth. And what you've seen from the government over, I would say, the past 5 years is a lot of subsidies in creating startups, sustaining a startup ecosystem. So there's shred credits. I know there's also provincial programs that if you are in India and you have an idea, all you have to do is show it to a provincial office and they will provide you a visa as well as office space in some province. So they're very business positive in terms of startups. They provide subsidies and it's an aspect of their growth plan that is necessary, but they're also taking advantage of the US just tripping over themselves on proper immigration regulation and policy.
yeah, I mean, I always found that when I criticize US immigration policy, I don't criticize as much, even though like I am affected by it.
Yeah.
Because I've seen other immigration systems. US immigration policy works in general for 95% use cases. It is really that only Indians, it doesn't work. Um,
Well,
Even for Chinese, it it works, but a little bit delayed. It takes 5 to 6 years for them to get a green card. Um, but that's the other problem of how many H-1Bs you are issuing. That can be increased. I think we can make an argument for them. But in general, the way the system operates, well, you compare it for like the rest of the world, not just Canada, I I genuinely think it actually is straightforward when you compare with just other systems, paperwork, everything, right? Obviously, you can say there are some other better systems. There's a lot of scope for improvement, but it really gets stuck up with Indians. It's where like US stumbles, and then there is the illegal immigration side, which is a whole different topic. That
right, right.
yeah,
And
that I think we should not get into now.
yeah, I don't want to turn a tech podcast into a political one. And I don't think either of us do. The I it's still I know very well paid and high ranking people at even tech firms here in Seattle and in San Francisco and New York that are still not full-fledged citizens, but close to making on a full comp basis nearly seven figures a year. And what's odd to me is that, okay, these people are part of critical systems, critical aspects of our economy, but we can't bring them in to be citizens. Like they can't access credit, they can't access other aspects of being a citizen. It's that's what's frustrating to me, and especially on I think on the staffing side too. It's if there is someone that is highly skilled, we need to be able to provide them a pathway to come to the US. I think what the UK did was very, very interesting. Albeit the bar is a bit high, but I kind of like the direction that it went. If you went to a top, and don't quote me on this, but if you went to a top, say 50 or 100 university in the world, bring us your degree and we will give you a visa and we will also give you an expedited path to citizenship.
Hmm.
We don't have that here. But
Hmm.
for us, it's an opportunity because we are focused in Vancouver. We have a good network there, and one example of kind of this immigration holdup is in the last Seachange fund, we backed an Iranian immigrant and now Canadian citizen that had a solvo metallurgic process to refine and smelt metals that was quite novel. Um, an incredible founder. And he tried so hard to raise money in Canada and just had the most difficult time. We found him, we backed him, and it's been a fantastic investment for us. So there, and that's one of many stories that have happened and that will happen not only through our fund, but anyone else that backs founders in Canada and mainly in for us, Vancouver and Western Canada.
Um, so let's slightly shift gears. Let's talk about, some of the investment trends that are happening, and mainly AI. And I think there's sort of like two worlds right now in investing. One is like if you're a regular founder who's not, added AI to your domain, you're not any keywords on your pitch deck about AI, the funding environment is completely different. And if you have AI or you're, doing something with AI, the funding environment is sort of different. So that these two parallel worlds going. So what's your macro view on what's happening with AI and what you're seeing in, you know, with AI in Seattle?
Yeah. On another funny side note, I read somewhere that Anguilla was getting now some large percentage of their government's revenue. I think it's 25 or 30% is now attributed to domain licensing because of the .ai. I heard that and loved it. The world is a wild and crazy place, but the stories always put a smile on my face. Uh, so here's the thing. I think when AI first started to become a very much a thing, a lot of people jumped into it with high hopes and kind of putting into place a SaaS playbook for any investment and didn't really take into account the rapid amount of progress that an AI focused company can make if they're, say, not building their own proprietary model, but actually just using AI tools to go out there and build product, get customers. And one of those things was I started noticing that almost every pitch deck was much better than I'd seen in the year before. And I had to check myself, okay, this isn't the execution of a founder. They just knew the right tool to make a great looking pitch deck. But I'm kind of getting distracted here. There were a lot of GPT wrappers, and the question that I would always ask, and normally it's a question I ask later on in a call, but I ended up front loading it in kind of this early days of Gen AI investing. It's that show me your architecture, right? And if you can't show me your architecture, and then I'm already going to be concerned. But if you do, and I realize it's a wrapper, I'm done. It's not that interesting to me unless you're, say, for very vertically focused or hyper focused on a specific use case that has horizontal application. Um, Within that, there are great founders, but you need domain expertise. I saw a lot of people spinning off from you name it tech company with, hey, we're going to go after this and solve this problem. Great. Who on the founding team, or at the very least, on your advisory board, has experience either selling or building product in this market? So there was always this mismatch of people building really cool stuff, but didn't have the true domain expertise to go and execute against it. I think now, mainly after OpenAI Dev Day, there's there's been kind of a humbling of what is actually going to take, what it's going to take for an AI company to really take off and have defensibility and it not just to be a go-to-market endeavor. So that's post Dev Day. I think where we are now is and this is hard for me. I think what really caught me up was Runway. Runway was a team that was laser focused on a specific idea, had tons of backing, and Sora comes out and it's much better than anything Runway, not anything, but you could tell from the Sora videos that the fidelity that was coming out of their model, the output of their model was much, much better than Runway's. And where I got concerned was how do you compete and how do you not fall subject to the aggregation theory that is OpenAI or any of these larger proprietary models? So I think there's going to be a lot of losers. I think if you're going to be doing something interesting in this space, you have to be going, you have to have an agent, a multi-agent and multimodal focus on where this industry is going to end up. And if you can't find a nice niche within a multi-agent ecosystem, then you're not going to win. And that's a 2 hour long conversation to get into, but that's kind of where I see AI going. Um, but I do get concerned just through aggregation. And I know Runway's more on the creative side. That's a place that I don't like to play in. But it's still a great example of my concerns around, okay, team laser focused. They're going after one product, but at the end of the day, it's the power of the model and the aggregation and as well as the quality of that model that's going to win. But can you compete from a proprietary basis? Or we're not going to get into those deals because I don't like investing in a company with 100 million at pre-seed, so to say. That's not where we're looking to play. We want to find those people that have domain expertise, are hyper focused on either a specific use case or vertical, and are attacking the problem set with aggression.
It's also impossible for a small fund to get into those AI deals now because every deal is like, you know, 30 million at 100 million pre or something like that, right? It's always in hundreds of millions. The first outside fundraise is in hundreds of millions
Right.
pre-money valuation. So it's almost that. It's only like large funds which have raised for a different purpose are actually investing at that stage, right? But yeah, that was a great insight. Uh, One, I think the opportunity in AI, obviously, it's a huge opportunity overall, but I think there's a big long tail opportunity for small teams. I think non-venture funded even to actually create tools in the short term before AI sort of goes into the mainstream. It's still like ChatGPT is one of the fastest consumer adopted product, but I think there are so many small niches in terms of like helping people do these menial tasks before like all these tools get actually to a level where it is usable from the company itself. Like Sora is itself not usable yet, but you can create something, the first version of it, which can be helping someone who's making GIFs, for example, right? That's an easier use case to solve than for a storyboarding for a Hollywood creator. Like, so I think there's a lot of small, long tail niche opportunities which will be multi-million dollar revenue businesses that can be captured by small team full stack developers. That I think is very interesting to me to see. And a lot of indie creators are jumping on this and scaling to like 100K ARR or 200K ARR within a very short span. I
And
think
and
we,
and go ahead.
I think
I
we,
was
the timing opportunity is limited on that, but it will stay for a couple of years, is my thesis.
no, and I agree with you. I think the other thing too that AI has opened up is that there are, especially for smaller funds, like, hey, if you're a Sequoia, if you're a Kleiner Perkins, like, hey, run at those proprietary foundational model oriented deals. That's fine. Like,
Yeah.
I'm not going to get enough equity ownership percentage in those deals that makes me feel capable of providing returns to LPs. And it's, I think if you have these smaller teams that are hyper focused on specific use cases and making just a better baseline of software to where it actually AI can actually hit into the enterprise, that's fantastic. because a lot of times these teams will only need pre-seed or seed funding to get everything off the ground, and they'll be smaller rounds. I
Right.
I I think that a lot of the good founders that came after the past 15 years and are repeat founders have noticed that they've jumped onto the VC treadmill too easily. And if you do, uh, don't get me wrong, getting backed by A16Z or Sequoia is fantastic, but you're going to be on that VC treadmill. You're going to get a giant check at a giant valuation at pre-seed or seed, and there's going to be expectations that come with that capital. But don't worry about it because we're incredibly well networked and we're on your cap table and we're a great marketing piece. Yeah, you haven't hit that valuation yet, but you haven't grown into this valuation yet, but that's fine. Here's a Series A, and so on and so forth. So I think that there is this there's two kind of trains of venture right now. There are those that are still jumping on this on the VC treadmill, which is totally fine. Don't get me wrong. There are companies that need that, but I'm really biased towards founders that are, hey, I can raise 3 on 15, but I don't want to because I want to see if this even works and if this has semblances of product market fit. And I'm hyper focused on this specific use case or this specific ICP, right? I really enjoy those founders. And from what I've seen in our portfolio and in just in investing is that most of the time those do much better. And I also believe that it's attributed to equity ownership from the founders is much, much better at later stages when you're much more frugal about how much you raise and who you raise it from than just going for a larger round. And I've heard, I think we're out of this period of say Insight Partners and later stage funds doing pre-seed and seed deals. I haven't seen many yet, but I saw several instances of founders getting offered, $10 million at pre-seed, no deck, no MVP, no nothing. And some of those founders took those deals and they're already in hard times. Meanwhile, those that rejected it and raised a smaller round are continuing to build and continuing to grow revenue. Capital can be a distraction.
Yeah. I think you, it's almost like, I think, I forgot who said it. I think it's Ashwini from Engineering Capital who said, like, there is a certain physics of venture capital. Like, certain ideas fit in that physics, and certain ideas never fit in that physics. And I think a hyperscaling $1 billion opportunity is a different one than this at max can be a 10 million revenue generator, right? So for the second option, you're better off just getting a small team together, and it will be a great personal exit for all the team involved, rather than going via venture option, and burning the whole thing down at some point. Because
Yeah.
that's what the conclusion has been for a lot of Zerpera fundraisers.
Hmm. Well, and I think there's also like pre-seed and seed investors could do a better job too of if there is a true bootstrapping opportunity, then tell the founder that it's a great bootstrapping opportunity
Yeah,
and don't just try and throw a safe at them to get
yeah,
into it. And this is maybe me being more risk averse than I had previously talked about, but bootstrapping opportunities are going to be all over the place in the future, more so than in the past. And we're not doing right. I think you need to be helpful in any ecosystem or whether that's the US as a whole, North America as a whole, or Seattle in a micro sense, but you have to be good to the ecosystem. And if there's a true bootstrapping opportunity, tell the founder that it's available to them and they don't need to run into this treadmill of VC and I also think there's a lot of entrepreneurs as well. And I think that's a good way to delineate whether they're really into running a venture scale business or if they really want to kind of just build something on the side.
I attribute that to sort of like this thought leadership aspect of venture capital, which focused a lot on storytelling versus building. They always, sort of perpetuated this idea that all the founders should be great storytellers. And a bunch of founders came up just being storytellers. And because that was all required for raising the fund. And during Zilker, it was easy to raise a fund as a storyteller than actually building a company and building MVPs and getting products out, getting customers. So it was easier to be a storyteller. I think a lot more people can be storytellers, right? If you watch enough videos, or if you understand the mindset behind how to sell something, it's much easier to at least nail the fundraising process than actually be building an application and building something new and getting that out in the market and taking the feedback and iterating. Like that's much more harder to do
Hmm.
than coming up with a story on raising a fund because you know what is working in the market right now. Yeah, it's working. Let's not raise some money around it. That's easier than actually building an AI product, right?
Yeah, and I think that's also software as a service became the playbook got perfected. It was everyone knew how to assess it from an investor standpoint. If you're an operator, there was a playbook to run through and how do you differentiate in fundraise? Well, it's storytelling and it really became a go-to-market function. SaaS was a go-to-market function. And I think now that we're in this new age of LLMs and generative AI, I think now there's a much deeper requirement for technical depth as well as storytelling that's throwing off the market a little bit right now, but it's a good time. I think people are having to be introspective and be a lot more methodical with how they're not only conducting due diligence but also trying to understand the market because it's going to be a different playbook. There'll be similarities, but it will be a very different playbook at the foundation of it.
I mean, for the storytelling, I always say, build a great product or company that becomes a great story. Don't start with just storytelling,
Yep.
right? You need to go from bottom up. Um, yeah, but this has been a very good conversation. I think we can go on for another hour if you want to. But
Yeah.
I know I want to be respectful of your time. Thanks for coming on the show. Where can our listeners find you? What's the best way to for founders listening to reach out to you?
Yeah. Our website, breakwater.vc. I'm also as active as I try to be on Twitter at PJS Mueller. And yeah, I appreciate you having me on the show, and hopefully we get to do it again.
Yep. Thanks, Peter. Thanks for coming on the show.
Thank you, Nataraj.